Welcome and thank you for joining us. In this session, we'll be providing a Q3 2024 markets update and an overview of the economic outlook for US expats in the light of last week's election result. Please note the webinar is for informational purposes only. It's not intended to offer advice or guidance on legal, tax, or investment matters. Such advice can only be given with full understanding of a person's specific situation. So let's meet our panelists. Tom is founder and chief investment officer at International Asset Management, a US registered investment advisor specializing in discretionary investment management for Americans living abroad. Tom has an MBA in global management from the Thunderbird University in Glendale, Arizona, and holds the Chartered Financial Analyst credential and is a certified financial planner practitioner. Tom lives in the San Francisco area, having previously lived overseas in several countries. He's been providing investment advisory service to American expats for over 20 years. Shane Clark is president and co-founder of EuroAmerican Financial Advisors. Shane holds the European Financial Planner designation and specializes in financial advice and investment management for Americans in Europe. With over 10 years of experience in international financial markets, Shane designs balanced and diversified global portfolios for long-term returns. Shane has been an expat for 15 years and holds an MSc in Financial Economics and an MPhil in Economics from the University of Strathclyde, Scotland. He resides in Spain. If you'd like to schedule a consultation to discuss your personal financial planning or investments, go to euroUSAFA.com or IAMadvisors.com. Okay, let's get started. Over to you, Tom.
All right, so I'll share my screen here, start the slideshow. Okay, hopefully that's working all right. If it isn't, somebody let me know. Right, so Hugo went through a little intro, just to kind of follow up on that a little bit. The firm I started, International Asset Management, started that in 2002. We've got about 100 million under management. We have clients in about 35 countries, and we specialize in services for Americans living abroad. We've been doing that since day one. About 90% of our clients are Americans living abroad. Shane and I started EuroAmerican Financial Advisors together a few years ago. That firm holds our European license. And we're licensed throughout the EU through that firm, and Shane is based in Spain. So enough about us, though. Let's get to what people are interested in here, which is what's going on and what the future might hold, basically. And so let's first have a look at what investment markets in general have done since the beginning of the year, so year to date. And it's been good, mostly it's been good anyway. And basically the S&P 500 up about 26%. Gold actually was doing even better. It was up over 30% here. It's gone down since the beginning of November a little bit. Bonds haven't done too well, but as interest rates have come down a bit, even bonds have strengthened a little bit. It's probably not a bad time to be in a long-dated bond fund for more conservative investors, especially because some of those funds are trading at historic lows almost. And then kind of middle of the road, if we look at emerging markets and things like non-US markets, but really the US market and especially the technology stocks that drive that market have done very well year to date. And so now let's have a look a little bit at what has happened since the elections. So this is basically since the beginning of November. So you're looking at just a few days, but obviously good for the US market, up 5%. And you can see on November 5th on election day and the day after and so on, the big change, right? Pretty much everything went down except for the US market. So that's pretty much what you would expect from the Trump America First kind of rhetoric. So what is really gold for some reason went down. Maybe it's just because it's been up so much. There's no real reason, I don't think, for the price of gold to go down at this point, but you do expect some kind of a reaction when things have gone up a lot. Everything has been kind of middle of the road. The things that have suffered are emerging markets and non-US markets, and part of that is a currency effect because the US dollar also strengthened on the Trump election news. And And part of that is just the fact that, the America First kind of policy. It's generally thought to be not too good for other places that might have higher trade barriers and so on and so forth. And then getting down into, looking at some emerging market companies. So, China was down 3% on the news, Thailand down 5%. Generally not good news for emerging markets, the Trump victory, which is pretty much what we would expect as well, right? The whole trade barrier kind of thing. And then if we look at the sectors, this is kind of interesting too, but again, it's exactly what you would expect. Oil service companies, for example, up 13% on the news. What hasn't done well in this is we'll have a look at that later, but things like uh, solar companies and so on. Probably not a big fan of that. President-elect Trump. Aerospace and defense also up, financials up, oil companies up, and then other things like healthcare and pharmaceuticals down basically, and utilities as well. So pretty much what you would expect from that rhetoric. If we look at some specific companies, well, obviously, anybody who watches the market knows that Tesla's way up because Elon Musk is going to help run the show, apparently. So it's up almost 40% on the news, on the election victory. But then other sectors like, for example, Cheniere, which is a producer of natural gas in the US, probably the leading producer of natural gas exporter, up 15%, Exxon up 5%. And then you look at companies that are in things like green energy, First Solar, for example, which has been doing pretty well recently, down 10% on the news. Interestingly, other companies like General Motors up also 13%. So that again is a function of the protectionism, but it's not overall protectionism because Trump policies might be good for the auto industry in the U.S., but they may not be good, for example, for the farming industry, which is so we're also looking at Archer Daniels Midland here, which is a maker of fertilizer and those kinds of things. So they're down 5% because the expectation is, okay, you put up trade barriers on China, well, then that swings both ways. And what China buys from the U.S. are things like soybeans. So not particularly good for farmers who overwhelmingly voted for Trump. But okay, let's see how that works out for them. So gives and takes definitely in that, but basically just a knee-jerk reaction. You don't. We'll see if this continues. I don't think it will. Let's look at something a little bit longer term, which is the U.S. economy overall. So if you start at the right-hand side of the page, it starts at 2012. And then you get to 2023, and then there's 4 quarters from there, right? Q4 2023 all the way to Q3 2024. And what you're looking at here are economic indicators. So these are leading economic indicators. So they're supposed to sort of prophesy what the economy is going to do over the next, say, year, 6 months to a year anyway. So green is good, red is bad, right? And if you start at 2002, you can see a lot of green. Then we got into some red here just recently, and people started talking about a recession a little bit. But then as the quarters have advanced from Q4 23 over the last year, things have gotten a little bit brighter. You can just kind of look at that qualitatively. But generally speaking, things have gotten a little bit brighter. So there's this inflation or this recession scare that we kind of went through. And it has lessened, at least in the US, it has lessened. Europe, maybe not so good, but in the US, it has lessened recently, partly because interest rates have come down, inflation has come down, right? About a year ago, we were looking at pretty high inflation. That's been brought down under control. So Trump is inheriting, I would say, a not too bad picture overall economically in the US. And obviously, his policy, Republican policy in general, of low tax rates and so on, they're thought to be good for business, and so the market has responded to that recently. So generally, the takeaway from this slide is that things are not looking that bad in the U.S. You look at things like housing starts, building permits; they're starting to get going again. Obviously, the stock market's up. Manufacturing index is positive, not super positive, but positive enough. And so things are not bad. Now, the other thing that Trump and Republicans in general traditionally talk about, and sorry about the quality of this slide, but it's the trade gap, exports versus imports, and that's one of the things that he hopes to remedy by putting tariffs on China and maybe Europe as well. Let's see if that works. But this is where we're at. The red line is U.S. imports, the green line is U.S. exports, and well, you can see what has happened over the years. But the flip side of this is that the U.S. has gone, as most industrial economies do go over time, from more of a manufacturing type economy to more of a services type economy, and services are a big part of the U.S. economy. So you don't necessarily export as much in terms of services as you would in terms of goods, the way that China exports to the U.S., right? So we'll see if we can narrow this a little bit. It'd be nice if we could, but that is certainly something that hopefully we're looking forward to under the Trump administration and under Republican policies in general. The other thing they talk about is the debt. Well, everyone's talking about the debt and what's that going to mean for the dollar. And especially, I talked to a lot of Americans living overseas. This is a concern of theirs. The dollar might lose value. I'm going to move all my money into a bank in Argentina or something like that. Before you do that, by the way, you should think about, because I get a lot of this from people who move overseas, dealing with expats for over 20 years. You always run into people who are doing things like buying farmland in Uruguay, and that may be a great investment. But let's not forget that in the US, we have strong investor protections. Yes, we have problems like we had in 2008 with banks collapsing and so on. But at the end of the day, we can get ourselves into a lot of trouble in the US, but we can also get ourselves out of it. And we do have strong investor protections that you don't get in other places. Like, for example, we have SIPC protection, $500,000 per account. Well, if you go to Europe, a place like Ireland, their protection is 20,000 euros, and Ireland's a developed economy that's doing very well. So in other places, you don't necessarily get this. And the US dollar is still the number one currency for trade. We have the deepest treasury bond market. So it isn't like the US dollar is going away, although it'll probably lessen in influence over the years and maybe generations to come. But one of the things we've been looking at is, what about the debt? It's been steadily increasing, and the Republicans used to be the party of fiscal austerity, if you want to look at it that way. They were always talking about lowering the debt. Well, not so much anymore, right? In recent years, both administrations have really not paid a lot of attention to this, and it's really ballooned. Obviously, during COVID, it went up a lot. But we need to keep this in perspective. So Japanese debt is double this. Other places, even China has a debt over 100% now. So we need to keep it in perspective. I'm not saying it's not a problem. Excuse me, I have a bit of a cold. Saying it's not a problem, but maybe it isn't something that's immediately going to cause us some issues. It's more of a longer term type thing. And so that's kind of all I had to say. But the takeaway from all of this, as far as I'm concerned, is we pretty much got what we expected. I think if Kamala Harris had won the election, probably would have gone the other way. Probably the market would have gone down. Trump's and Republicans winning, market goes up. Certain sectors do better than others. But I do think it's a knee-jerk reaction. And it isn't something you can bet on now. It wasn't even something you could bet on before, even if you were quite convinced that Trump would win. It would have been hard to bet on that. You could have maybe bet on Tesla. But I think overall, it's best to do what we've done. Historically, if you look at what has happened during election cycles, the year before, the year after, where the Republicans win or Democrats win, historically, statistically, from an investment perspective, it really hasn't made that much of a difference. At the end of the day, my advice is, don't get too excited about this. Sure, there are some things we can do. Sure, probably having some money in oil companies and being a little conservative around maybe solar companies and other green type energies, that might be a good idea. but it was a good idea before this too. I mean, frankly, the oil companies were making money and the green energy companies weren't, right? And so you got to look at the economics of all this stuff, whether or not you like it. So in general, I would say keep a diversified perspective on this, have a diversified portfolio. That's generally what we do anyway. And just think of it as generally good times in the US, better time to be invested than not invested. The world isn't falling apart. I don't think the world's getting a lot better because of Trump either, but it's not falling apart. And so from an investment perspective, just steer the ship and as we always have. And I think for more conservative investments, it's a good time to look at some of these bond funds and that are trading at historic lows at a time when the U.S. stock market has gone up a lot and other markets have gone up as well. And that's just common sense what we do in investing. So a little bit of rebalancing from time to time. So that's really all I had to say, and I'm going to pass it on to Shane for a European perspective on all this.
Great. Thanks, Tom. Let's get my screen shared here. Start the slideshow. There we go. Okay. So yes, I wanted to, Tom's given a good overview of the US markets, kind of the global markets. I want to focus on the European markets and particularly the trade and also currency fluctuations between the US and the euro. I'm based in Spain. It makes sense, right? So looking at the Eurozone in the third quarter, it isn't as good as the US from a rosy kind of glasses picture, but it isn't bad either. It's continuing to perform better than expected. So the big fear kind of going into the year was there was going to be a recession in the EU. Times are going to be really tough. They're going to have to cut interest rates at a faster pace. That hasn't panned out to be the case. Things are improving. Energy prices have come down considerably, and that's created a lot of growth. So looking at kind of the big highlights here, in Q3, GDP outperformed expectations, particularly driven from two countries, Spain and France. Germany has continued to struggle, and as you probably know, Germany has kind of been the backbone of the EU for many years. They have a very diverse economy, particularly driven from manufacturing, all the auto industry, pharmaceutical industries. They really began to suffer years back when they turned off their nuclear energy production. They were relying on energy coming from Russia primarily. And with the situation there, they've suffered from being able to continue their output due to restrictions on energy. So that is continuing to plague them. But things down here in the south are going quite well. So looking at inflation trends, inflation has continued to fall in the EU as well, down to 1.7% in September. And, something to point out here, I think the way we measure inflation is a little bit misleading. So there's two primary instruments that we look at, consumer price index and producer price index. And those are really looking at a basket of goods for consumers and a basket of goods that generate production for producers. That's a year on year, every month percentage change. So that's, to say that inflation is going down is a little bit misleading because yes, the year on year change is going down, but the overall index level this year versus last year could be significantly up. So a lot of people think, well, prices, in the US are particularly up from 5 years ago, and that's true, and they're not going down anytime soon, but the inflation trend is slowing, and that's the important thing. That's what the central banks have been doing, trying to combat that by raising interest rates. So having said that, it is improving over here in Europe as well. Looking at unemployment, unemployment has stabilized. It's around 6.5% in Q3, which, it's not the ideal 2 to 3% target, but it is improving. I think after COVID a couple of years ago, that really hurt a lot of the markets, particularly down here in the South. A lot of businesses had a harder time recovering. There wasn't as much stimulus in the EU as there was in the US to combat this. And it's been a little bit of a slower recovery. So having said that, how does this affect your investment portfolio? So that's what we're all really worried about, right? Currency. So a big issue, looking at any currency that you're living in. So if you come from the US, you have the US dollar. I'm going to use Europe as an example. So we have the euro as the currency that your expenses are in. So anytime you have your money or your assets in one currency and your expenses in another currency, that creates a risk. And that's something that you need to address. It's a base level risk. You can address it in many ways, but you need to be conscious of it and you need to look at it for how you manage your investment portfolio. That's something that we focus on, that we actively manage. Two different approaches. You can actively hold euros, or that would be a direct approach to managing the currency risk, or there's indirect approaches. So you could hold companies that could still trade on US exchanges, but they're going to derive their revenue from the euro. So there's direct ownership or indirect ownership, something to look at. In terms of currencies, what's going to happen with the euro? I don't think anyone knows right now. There's a lot of uncertainty. So I'm going to present kind of two paths. One path, the dollar appreciates relative to the euro. So what makes currencies appreciate are primarily what happens with GDP growth in the country, what happens with the trade imbalance between the two countries, and then what happens with interest rates relative to the two countries. So if the US were to radically raise interest rates and the EU was to radically decrease, the US dollar would increase in value relative to the euro, everything else staying equal. Same thing with the trade imbalance. If the US started exporting more to Europe or started importing less, the dollar should increase. And then in terms of interest rates, we talked about that. GDP, if the GDP in the US continues to outperform, it should strengthen the dollar. So, there has been some activity in the US recently with the election that has people kind of guessing what's going to happen next with all those things I just discussed: interest rates, trade imbalance, GDP. So one path is the US dollar strengthens relative to the euro because they improve some of the government spending, they get the debt under control, that reduces some of those things that hold back the dollar's value relative to other currencies, and the dollar appreciates. Currently, the US dollar to the euro is a little bit outside of historic levels. The dollar's stronger. So the other side of the coin would be, what if the euro appreciates? What would be the cause for the euro to appreciate? Right now, in both zones, the US and the EU, it's a little bit of a race to the bottom in terms of cutting central bank interest rates. So it's an anticipation of which bank is going to cut faster. If there's continued concerns over here with unemployment and recession fears, then the ECB should cut rates at a pretty fast rate. If that happens, then the euro will depreciate more to the dollar. If the US, conversely does the same, then the euro should appreciate. So there's a lot to consider. I don't think anyone has the crystal ball for what's going to happen with these currencies. So as Tom said, it's good to take kind of a broad perspective, a long-term perspective, manage the currency risk, don't do anything crazy, and have a diversified portfolio on top of that. Looking at real estate, again, looking at interest rates, kind of a theme here. Usually what happens when interest rates go down, real estate prices go up. Money becomes cheaper, it's easier to buy, it's easier to mortgage. So that's kind of what we're seeing in the EU. With interest rates dropping, real estate prices are increasing. Looking at asset allocation in terms of what percentage of your portfolio you allocate to emerging markets, to EU stocks, EU bonds, that's an important consideration right now. Usually what happens if the US dollar strengthens, that's hard for emerging markets. Looking at EU and EU bonds, EU stocks and bonds, if interest rates are decreasing, usually bond prices increase. And that's what we're seeing right now as well in the EU bond market. So EU specific tax regimes that are favorable, we're kind of seeing a negative trend right now for this. A lot of the countries are cutting, really kind of restricting some of these favorable golden visa programs, digital nomad tax regimes, a lot of the things that attracted a lot of investment. We're seeing a bit of a backlash. For example, in Spain, there's been a lot of increase in property prices. So a lot of people are blaming expats for that, increasing property prices. They want to get rid of the golden visa programs. They want to get rid of some of these different special, more favorable tax regimes. So if you're thinking about moving or you've recently moved, I would say speak with a lawyer. There's still some golden visa options, but they're becoming more and more restricted. And then kind of diving into the traditional stuff, what's happening in the EU right now with regard to monetary policy and cutting interest rates. The ECB has recently reduced the deposit rate to 3.25%, kind of to help the economy grow, avoid a recession. And we anticipate that's going to continue on that trend probably until around 2025 and kind of plateau at 2.5%. So we think that's going to help boost the economies here in Europe and probably further increase bond prices. Financial markets, European equities historically haven't been as attractive as US equities, especially in technology. We have seen energy and healthcare kind of leading in Q3 anyway. So what are the opportunities here? Energy stocks, there's been a huge investment in renewables, particularly in the South, and that has performed quite well. Fixed income markets, we do see an opportunity here in bond prices rallying as the ECB continues to cut rates, both in terms of, there's kind of two opportunities. One, if interest rates are going down, you could lock in a high yield in an individual bond. The other option would be buying a fund, maybe with medium or longer term duration, and seeing the price appreciate. So yield's going to go down, but the price of the fund appreciates. And then currency exchange, the euro has weakened to the US dollar, particularly with the election. And, we're going to see probably, I think I already discussed that in length, but it's something to monitor. And then what's going to happen next? So economic outlook for Q4 and 2024, I think there's a lot of questions, particularly between the US and the EU with what's going to happen with trade relations, with what's going to happen with interest rate cuts. So the big drivers of the economies and, what happens with inflation. So does inflation continue to go down here? Do energy prices tick up further, which is really the kind of the root cause of inflation over here? So that's something to monitor. I think the ECB's policy is pretty clear right now. It's just how fast they're going to continue to cut. If unemployment continues to rise, if GDP starts to slow, we'll see a faster cutting of interest rates by the ECB for sure. If inflation continues to creep up, then they're going to slow that down, and that'll impact the exchange rates between the two currencies. So investment implications, I think we're going to expect to see a lot of volatility in the markets in the next couple of quarters. There is a little bit of a perfect storm here, I think, in the US with the Republicans getting back in office and interest rates going down. Everything, as Tom showed, it's not entirely rosy, but it does look promising. So I think we can be optimistic versus pessimistic for the time being on that side. And that's, really all I wanted to talk about. Just kind of a brief overview there. I think we've got time for some questions. If there was any that popped through in the chat.
Yes, there are couple of questions come through. So thank you both very much for those presentations. Um, the first question is relating to currency risk. So if you have investment assets in dollars, you're living in an EU country, so your expenses are in euros, but you're paying your expenses from income in euros from employment. Is there still a risk? Is it something you should still diversify your portfolio into both currencies?
Yeah, I'll take that one. I think it's always a risk. If you have the bulk of your assets in one currency and you have your expenses in another currency, even if you're currently deriving income from that currency, it's something to consider for long term, how to plan we look at that in the financial planning process as well, how to kind of future-proof your investment portfolio. I would say if you were living in South Africa, for example, it'd be a lot bigger risk. If you're living in the EU, the dollar historically has been the strongest currency, and currently the euro is probably the second strongest currency. So it's a risk, but it's not as life-threatening as maybe other situations.
Yeah, let me add to that here. I'll share my screen briefly too. Just have a look at let's see, this one here probably. So this is the euro US dollar exchange rate. I'll make it a little bit bigger over the last 25 years, right? And so you can see there's ups and downs, but there's a fundamental difference because people talk about investment markets. Well, this is a currency market, not an investment market. And the fundamental difference is that currencies, at least the major currencies, tend to be mean reverting, unlike, say, the stock market, which tends to go up, if only because of inflation. But so where do you bet on this, right? I mean, the dollar has been strengthening since about 2000, what is this, 2008, right? Since the financial crisis versus the euro. But generally speaking, we're in this range. So I think it's pretty hard to bet on something like a US euro exchange rate. I mean, there might be some near-term effects and so on that you can think the dollar might strengthen because of the Trump policies. But longer term, these are both, as Shane said, these are both pretty stable currencies, and so it's pretty hard to bet on a direction. So what I would say is, if you're, the question was, well, if you're paying everything out of your income in euros and you still have investments in US dollars, I wouldn't really spend a lot of time worrying about that because these currencies are investment reverting. And the other thing is, even if you spend your money in another currency other than the US dollar, the dollar tends to strengthen at times of strife. So, for example, when you have a recession or a financial crisis, the dollar tends to strengthen. And so having some of your investments in US dollar kind of provides a hedge for that. Because if you think of what that money's doing, converted into your currency, well, the stronger dollar would support that maybe at a time when the stock market is going down. So that's the other aspect of this kind of multi-currency investment scenario.
Thank you. There's another question here, which says, what sectors in the EU are there good prospects for growth?
What sectors in the EU are good prospects for growth?
Yes.
Well, it depends. I think whenever you look at that, you have to look at what are your options. So you have to look at that from a relative standpoint. So if you're looking at investing in, broad baskets, the US versus the EU, I think you need to look at, which regions make the most sense first, whether you look at it from a top-down standpoint or individual stocks. If you're looking at technology, for example, traditionally the US has been better for technology than almost anywhere in the world. If you're looking at individual countries, I think there's opportunities. And in general, I think over here, anything that's affected by energy prices is probably not going to be a great opportunity going forward. Healthcare has continued to perform well in the EU. There's aging populations everywhere. So any particular company that, I don't want to say helps those people, but assists the aging population, those are probably good opportunities going forward. And, I would also say there's been a lot of investment with the kind of Green New Deal of the EU in renewables. So some of the renewable energy companies in Spain, Italy, those have done quite well.
Well, thank you both very much for taking time to join us today. And thank you to our audience as well for taking the time. If you would like to get in touch, the websites again where you can find the contact details are EuroUSAFA.com and IAMadvisors with an O.com.